You know, the great irony about building wealth is that the moment you stop chasing it desperately, it begins to find you. The more tightly you grasp at money, the more it slips through your fingers like water. But when you hold it lightly, with open palms and a relaxed mind, wealth accumulates almost by accident. This sounds like mystical nonsense, doesn't it? Eastern philosophy that has no place in the practical world of investing and wealth building. But I'm going to show you that this paradox, this fundamental principle of Wu Wei, or effortless action, is actually the most powerful investment strategy you've never heard of. The Western approach to wealth is exhausting. It's all force, all striving, all anxiety. Wake up at 5 a.m., hustle, grind, optimize every moment. Check your portfolio 17 times daily. Panic when markets drop. Get greedy when they rise. Live in constant fear that you're not doing enough, not earning enough, not accumulating fast enough. And you know what this approach produces? Burnout, anxiety, poor decisions, and ironically, mediocre returns. Because you're so busy doing that, you forget about being. You're so focused on the destination that you miss the fact that the journey itself is creating the outcome. I spent decades studying Eastern philosophy, particularly Zen Buddhism and Taoism, and one day I had a realization. These ancient principles aren't just spiritual platitudes. They're practical guides to how reality actually works, including financial reality. The Taoists understood something profound. Nature doesn't force things. Trees don't strain to grow. Rivers don't struggle to reach the ocean. The moon doesn't effort its way across the sky. Everything happens through natural processes, through flowing with rather than fighting against. And wealth building, when done correctly, works exactly the same way. Now, I'm not saying you should meditate your way to $1 million. I'm not suggesting that positive thinking alone creates wealth. What I'm proposing is far more radical and far more practical. That there's a way to build wealth that doesn't destroy your peace of mind, doesn't require heroic effort, and actually produces better results than the conventional wisdom of hustle and anxiety. The secret is what I call the way of intelligent inaction. It's based on 3 ancient principles that, when applied to modern investing, create a system so powerful and so simple that it feels almost unfair. These principles are Wu Wei, effortless action, doing by not doing, yin and yang, understanding cycles and balance, beginner's mind, seeing clearly without the distortion of ego and assumption. Over the next 40 minutes, I'm going to show you exactly how these philosophical principles translate into practical investment strategies that can build you $1 million fortune. Not through mysticism, but through mathematics applied with wisdom instead of anxiety. I'm going to show you why the investors who seem to do the least often accumulate the most. Why the ones who check their portfolios rarely outperform those who check obsessively. Why letting go of control actually gives you more control. This isn't about rejecting Western financial knowledge. It's about infusing that knowledge with Eastern wisdom to create something more powerful than either tradition alone. By the end, you'll understand why building wealth is less like climbing a mountain and more like watching a plant grow. Less about force, and more about providing the right conditions, and then getting out of the way. So let's begin with the most counterintuitive principle of all, Wu Wei, or the art of doing by not doing. The principle of effortless action. Wu Wei is perhaps the most misunderstood concept in Taoist philosophy. Westerners hear non-action and think it means laziness or passivity. It doesn't. Wu Wei means acting in harmony with the natural flow of things, rather than forcing and straining against them. Think of a skilled sailor. The amateur fights the wind and waves, exhausting himself trying to force the boat in exactly the direction he wants. The master sailor understands the wind and current, adjusts his sails accordingly, and arrives at the destination with far less effort and often faster. Both are acting, but one is forcing, the other is flowing. Wu Wei in investing. Set and forget. In investing, Wu Wei manifests as what we might call intelligent passivity. You make a decision once with great care and wisdom, and then you let it unfold without constant interference. The conventional investor, let's call him the doing investor, exhibits these behaviors. Checks portfolio multiple times daily. constantly researches new opportunities, frequently trades based on news, tips, feelings, adjusts strategy based on quarterly performance, actively manages every position, cannot tolerate boredom or inactivity, feels productive because he's always doing something. This investor is like a gardener who can't stop digging up seeds to check if they're growing. All that activity destroys the very process he's trying to accelerate. The Wu-Wei investor, let's call him the being investor, exhibits different behaviors. Checks portfolio quarterly or even annually. Makes investment decisions slowly and deliberately. Rarely trades once positions are established. Ignores short-term market fluctuations. Allows compounding to work undisturbed. Comfortable with long periods of apparent inactivity. Understands that non-doing is often the most productive action. Who do you think builds more wealth over decades? The research is unambiguous. The being investor, the Wu-Wei investor, dramatically outperforms. The mathematics of non-doing. Let me show you the actual numbers. Active investor, doing. Makes 30 trades per year trying to optimize returns. Each trade has costs, fees, taxes, bid-ask spread. Average cost per trade, $50 fees, plus $200 tax impact, source $250. Annual trading cost, $7,500, plus psychological cost of constant monitoring and stress. This drag reduces 30-year compound returns by 2 to 3% annually. Passive investor, Wu-Wei, makes 2 to 3 trades per year for rebalancing only. Annual trading cost, $750. Psychological stress near zero. Allows full compounding with minimal drag. Over 30 years, this 2% difference in returns equals hundreds of thousands of dollars. $10,000 invested annually for 30 years. At 8%, Wu-Wei approach, $1,223,000. At 6%, active approach, $838,000. Difference $385,000. The Wu-Wei investor literally makes hundreds of thousands more by doing less. This isn't mysticism, it's mathematics revealing what the ancient Taoists understood intuitively. Forcing rarely produces superior results. Why non-doing works, the psychological edge. But the real power of Wu-Wei isn't just the reduced costs. It's the psychological advantage. The active investor operates in a constant state of anxiety. He must be vigilant. He must act. He must respond to every market movement. This anxiety produces 3 fatal errors. Error 1. Panic selling. Markets drop 20%. The active investor, monitoring constantly, feels every point of decline viscerally. His amygdala screams danger. He sells to preserve capital. Markets recover. He's locked in permanent losses. The Wu-Wei investor barely noticed the decline because he only checks annually. By the time he looks, markets have often recovered. He never experienced the panic that triggers destructive action. Error 2. FOMO buying. Markets are soaring. A sector is hot. The active investor, immersed in financial media, feels intense FOMO. He buys at the top, convinced this time is different. The Wu-Wei investor hears about the hot sector eventually, but by then it's old news. His delayed awareness, his non-doing, protects him from buying tops. Error 3. Overconfidence. The active investor, constantly making decisions and seeing results, good or bad, develops false sense of control. He thinks his activity is producing results when it's actually destroying them. The Wu-Wei investor, doing almost nothing, cannot develop this illusion. His humility protects him. Setting up your Wu-Wei system. So how do you apply Wu-Wei practically? Here's the system. Phase 1. The contemplation. One time done carefully. Take a week, an actual week, to design your investment strategy. Not quickly, not impulsively. Slowly, thoughtfully, like a master craftsman designing a cathedral. Research asset allocation. Understand your risk tolerance. Choose your vehicles, index funds, target date funds, etc. Set your automatic contribution schedule. This is the only time you exert significant effort. Get it right because you won't revisit this often. Phase 2. The automation. Set and forget. Automate everything: monthly contributions from paycheck to investment accounts. Automatic investment of contributions into chosen funds. Automatic dividend reinvestment. annual rebalancing, if you even need it. You're now set up for Wu Wei. The system runs itself, you're freed. Phase 3. The non-doing, the hardest part. Now comes the discipline of inaction. You must train yourself not to. Check portfolio daily or even monthly. Read financial news constantly. React to market swings. Change strategy based on feelings. Trade for the sake of doing something. This is harder than it sounds. We're conditioned to believe that productivity requires constant activity. But in investing, as in many things, the highest form of intelligence is knowing when not to act. Set calendar reminder for once per year. Review portfolio. Until that alarm, the portfolio doesn't exist in your consciousness. The practice of financial meditation. Here's a practice I developed to cultivate Wu Wei in your financial life. Once per week, sit quietly for 10 minutes. Close your eyes. Think about your investments. Notice any anxiety, any urge to check, to change, to act. Don't suppress these feelings. Observe them. Watch them arise. Watch them fade. Realize they're just thoughts, not commands. This practice weakens the compulsive relationship with your portfolio. You develop the inner strength to leave things alone, to trust the process, to embody Wu Wei. Over time, you achieve what the Taoists call actionless action. You're doing something tremendously productive, building wealth through consistent investment and compound returns, but it feels like you're doing nothing. This is the paradox. The apparent inaction is the highest form of action. Real-world Wu Wei investors. Want proof this works? Look at the most successful investors. Warren Buffett buys great businesses and holds for decades. His most common advice, don't just do something, stand there. Jack Bogle created index funds based on the premise that the best investment strategy is to do as little as possible. Benjamin Graham preached buying undervalued assets and then waiting patiently for the market to recognize value. Notice the pattern? The greatest investors in history all practice Wu Wei, whether they call it that or not. They act deliberately and infrequently. Trust in long-term processes over short-term tactics. Remain unattached to daily fluctuations. Understand that patience is action. The trap of doing. Now let me show you the trap most investors fall into. The activity trap. Western culture worships busyness. We feel guilty being inactive. We equate activity with progress. This works well for some things. Building a house requires constant activity. Running a business demands daily action. But investing is different. Investing rewards intelligent inactivity. The activity trap manifests as trading addiction. Moving money around creates the feeling of control, but actually destroys returns. Research obsession. Spending hours analyzing stocks, reading reports, watching CNBC. All this activity produces no better results than simple index investing with zero research. Strategy hopping. Constantly looking for the better approach, the optimal allocation, the perfect investment. This prevents any strategy from working because you never stick with one long enough. Complexity worship. Believing sophisticated strategies must be superior. They're not. Simplicity and discipline beat complexity and cleverness. All of this is doing when non-doing would produce better results. The liberation of Wu Wei. Here's what Wu Wei investing gives you beyond just better returns. Time. Reclaim dozens of hours monthly not spent monitoring, researching, worrying. Peace. Eliminate financial anxiety from constant market monitoring. Energy. Stop depleting mental resources on investment decisions. Clarity. With less noise, you see reality more clearly when you do need to act. Joy. Money becomes background process, freeing you to focus on life. This is the promise of Wu Wei. Not just more wealth, but a better life while building that wealth. Your Wu Wei practice. Starting today, commit to this. For the next 90 days, you will not check your investment portfolio, not once. Set a calendar reminder for 90 days from now. Until then, pretend the portfolio doesn't exist. During these 90 days, notice the urge to check, the anxiety of not checking, the freedom that gradually emerges, the peace that comes with letting go. After 90 days, check your portfolio. I guarantee two things. It will be fine, probably up, possibly down, but fine. You'll realize you didn't need to check it even once during those 3 months. This realization that the portfolio grows best when left alone is the beginning of true wu-wei investing. The Taoists say, nature does not hurry, yet everything is accomplished. Your wealth will build the same way, not through frantic activity, but through patient, intelligent inaction. This is wu-wei. This is the first secret to building your million-dollar fortune, the principle of complementary opposites. The second great principle from Eastern philosophy that transforms investing is the concept of yin and yang. Most Westerners see this symbol, the circle divided into swirling black and white halves, and think it's about balance. It is, but it's about something deeper too. Yin and yang represent the fundamental truth that reality consists of complementary opposites that dance together in eternal cycles. Day and night, summer and winter, expansion and contraction, bull markets and bear markets. The crucial insight: these opposites aren't in conflict. They're partners in a dance. You cannot have day without night. You cannot have summer without winter. And you cannot have bull markets without bear markets. Western investing culture treats this relationship adversarially. Bull markets are good. Bear markets are bad. The goal is to experience only the good and avoid the bad. This is like wanting only day and no night, only summer and no winter. It's fighting reality. And fighting reality is exhausting and futile. The investor who dances with cycles, the yin-yang investor, understands something profound. Bear markets aren't the enemy. They're the necessary counterpart to bull markets. They're the winter that makes spring possible. Let me show you what this understanding produces. In bull markets, yang phase, the typical investor feels invincible, increases risk, buys more aggressively, develops overconfidence, forgets that cycles turn. The yin-yang investor feels cautious despite rising prices, maintains discipline, continues regular contributions without change, knows this phase will end, prepares psychologically for winter. In bear markets, yin phase, the typical investor panics, sells at losses, stops contributing, swears off investing, misses the recovery. The yin-yang investor feels opportunity despite falling prices, continues contributing, now buying bargains, sees winter as necessary for the next spring, knows this phase will end, prepared psychologically for the cycle. Do you see the difference? The typical investor is always out of sync with cycles, optimistic when he should be cautious, pessimistic when he should be optimistic. The yin-yang investor is always in harmony with cycles, cautious during yang expansion, opportunistic during yin contraction. The mathematics of cycle harmony. Let me show you how this plays out mathematically. Market cycle. Example, 2000 to 2020. Markets went through clear cycles 2000 to 2002, bear yin. Market down approximately 45%, 2003 to 2007, bull yang. Market up 100%, 2008-2009, bear yin. Market down 55%, 2009 to 2020, bull yang. Market up approximately 400%. Typical investor's journey. 2000, portfolio $100,000, stops contributing during decline. 2002, portfolio $55,000, sells in panic. 2003 to 2007, sits in cash, misses recovery until 2006, buys back in at top. 2008 to 2009, panic, sells again at $45,000. 2009 to 2020, finally buys back in 2012 at higher prices, nervous through entire bull market. 2020, portfolio maybe $180,000, underperformed dramatically. Yin-yang investor's journey. 2000, portfolio $100,000, continues contributing $10,000 per year through decline. 2002, portfolio $75K, down but accumulated shares at low prices. 2003 to 2007, continues contributing, shares bought during bear now soaring. 2008 to 2009, continues contributing through downturn, buying bargains. 2009 to 2020, continues same strategy, fully invested through entire bull market. 2020, portfolio $650,000, outperformed massively. The yin-yang investor didn't do anything complicated. He just stayed in harmony with cycles instead of fighting them. Understanding market emotions as yin-yang. Markets are driven by two fundamental emotions that alternate in cycles. Fear, yin. Cold, contracting, pessimistic, dark greed, yang. Hot, expanding, optimistic, bright. These emotions alternate like day and night. The key is understanding where you are in the cycle. Signs of extreme yang. Greed phase. Media full of stories about people getting rich quick. Your taxi driver giving you stock tips. Valuations stretch beyond historical norms. Everyone convinced this time is different. New investors piling in, convinced it's easy. When you see extreme yang, remember, yin is coming. The pendulum swings. Act accordingly, cautiously. Signs of extreme yin, fear phase. Media full of doom and gloom. People swearing off stocks forever. Valuations compressed below historical norms. Everyone convinced markets will never recover. Investors fleeing to safety. When you see extreme yin, remember, yang is coming. The pendulum swings. Act accordingly, opportunistically. The practical yin-yang strategy. Here's how to implement yin-yang awareness. Dynamic rebalancing based on cycles. Instead of calendar rebalancing, once per year, consider cycle-aware rebalancing. When markets feel euphoric, extreme yang. Rebalance from stocks to bonds more aggressively. Take a bit off the table. Trim from 80% stocks to 70%. This is selling high without trying to time the top. When markets feel apocalyptic, extreme yin. Rebalance from bonds back to stocks. Add a bit more equity exposure. Trim from 70% back to 80%. This is buying low without trying to time the bottom. You're not trying to time markets perfectly. You're just staying in harmony with the cycle. Pulling back slightly during extremes of optimism. Leaning in slightly during extremes of pessimism. The dollar-cost averaging yin-yang. Traditional dollar-cost averaging means investing the same amount every month regardless of conditions. This works, but we can enhance it with yin-yang awareness. Normal months. Invest your standard amount $1,000. Extreme yang months. Market feels euphoric. Consider investing slightly less, $900, and building cash reserve. Extreme yin months. Market in free fall. Deploy any cash reserve plus regular contribution, $1,500 to $2,000. You're still being consistent, but you're harmonizing with cycles rather than being rigidly mechanical. The emotional yin-yang. The hardest part of cycle awareness is managing your own emotional response. Your emotions naturally sync with the crowd. Optimistic during bull markets, pessimistic during bear markets. This synchronization is precisely what loses money. You need to cultivate what I call emotional yin-yang, the ability to feel the opposite of what the crowd feels. When everyone is euphoric, yang, cultivate inner caution, yin. Practice. When you read headlines about market gains, pause and think, this yang phase will turn. How do I prepare for yin? Visualization. See the market cycle as a wave. When at the crest, the trough is coming. Mantra. Trees don't grow to the sky. When everyone is panicking, yin, cultivate inner confidence, yang. Practice. When you read doom headlines, pause and think, this yin phase will turn. How do I capitalize on this opportunity? Visualization. See winter as the setup for spring. Seeds planted now will bloom. Mantra. This too shall pass. This emotional countercyclicality is the hardest discipline in investing. It requires you to be psychologically independent from the crowd. The 5 phases of market cycles. Traditional Chinese philosophy recognizes not just yin-yang, but 5 phases: wood, fire, earth, metal, water. We can map these to market psychology. Wood phase, early bull. New growth, cautious optimism, recovery from bear market. Smart money buying. Fire phase, late bull. Rapid growth, euphoria, everyone buying. Dumb money arriving late. Earth phase, transition. Plateau, uncertainty, first cracks appearing. Smart money selling. Metal phase, early bear. Decline, fear creeping in, denial that bull market ended, dumb money still hopeful. Water phase, late bear. Collapse, Capitulation, despair. Stocks are dead forever. Smart money buying aggressively. Understanding these 5 phases helps you calibrate your response. You can ask, which phase are we in? What does this phase historically lead to? How should I position for the next phase? Case study, the COVID crash and recovery. Let me show you yin-yang principles in action during the 2020 COVID crash. February 2020, markets at all-time highs. Extreme yang, sentiment wildly optimistic. Yin-yang investor. Action notices extreme yang conditions, doesn't sell everything but rebalances slightly toward cash/bonds. Takes a bit of risk off. March 2020, markets crash 35% in weeks. Extreme yin. Headlines declare worst crash since 1929. Predictions of decade-long depression. Yin-yang investor action. Recognizes extreme yin. Rebalances from bonds back to stocks. Uses cash reserve to buy at bargain prices. Feels fear but acts anyway because philosophy says extreme yin precedes yang. April 2020 to present. Markets recover all losses and soar to new highs within months, then continue rising. Yin-yang investor. Result: bought near lows, captured full recovery, portfolio significantly ahead of those who panicked. The yin-yang investor wasn't smarter, wasn't luckier, simply danced with the cycle instead of fighting it. The quarterly yin-yang check-in. Here's a practice I recommend. Every quarter, assess market conditions through yin-yang lens. Ask 3 questions. Where is market sentiment? Extreme optimism equals yang peak. Extreme pessimism equals yin trough. Somewhere in between? Where am I emotionally? Am I feeling greedy/confident or fearful/pessimistic? What does yin-yang principle suggest? If extreme yang, caution. If extreme yin, opportunity. If balanced, maintain course. Based on answers, make micro adjustments to portfolio. Not dramatic changes, just gentle rebalancing toward harmony with cycles. The acceptance of cycles. Perhaps the greatest gift of yin-yang thinking is acceptance. You stop fighting reality. You stop wishing bear markets wouldn't happen. You understand bear markets are inevitable. They're necessary, they're healthy, they're opportunities. Bull markets are temporary. They're wonderful but won't last forever. They require caution amid euphoria. This acceptance produces profound peace. You're no longer at war with markets. You're dancing with them. The Taoist text says, "The sage is sharp but does not cut, pointed but does not pierce, straightforward but not unrestrained, brilliant but not blinding." The yin-yang investor is similar. Alert but not anxious. Responsive but not reactive. Confident but not arrogant. Careful but not paralyzed. Your yin-yang practice. Starting today, set up sentiment alerts. Follow a simple market sentiment indicator, like VIX or CNN Fear Greed Index. Check it monthly. Create a cycle journal. Note your emotional response to market conditions. When you feel euphoric, write yang, be cautious. When you feel fearful, write yin, be opportunistic. Practice emotional counter-cyclicality. Deliberately cultivate the opposite feeling of the crowd. This is hard but transformative. Trust cycles. Remember that everything in nature moves in cycles. Markets aren't different. Winter always turns to spring. This is yin and yang. This is the second secret to building your million-dollar fortune. Dancing with cycles instead of fighting them. The principle of beginner's mind. The third principle from Eastern philosophy that transforms investing is what Zen Buddhists call Shoshin, beginner's mind. The beginner's mind is a mind empty of preconceptions, open to all possibilities, eager to learn. It's the opposite of the expert's mind, which is crowded with assumptions, certainties, and the need to be right. Shunryu Suzuki, the Zen master, said, "In the beginner's mind, there are many possibilities. In the expert's mind, there are few." This is profoundly true in investing. The more people think they know, the worse they typically perform. The moment you believe you've figured out the market humiliates you. The curse of expertise in investing. Let me tell you about the expertise trap. Someone starts investing. They're humble, cautious. They buy index funds, follow simple strategies. They do well. After a few years, they feel confident. They've learned the game. They start reading more, trying to get sophisticated. They think, if simple strategies work well, complex strategies must work better. They start stock picking. They can identify winners. Market timing. They can sense when to be in or out. Sector rotation. They can predict which sectors will lead. Option strategies to enhance returns. All this added complexity comes from the expert's mind. The mind that knows, that has figured it out, that is certain. And almost always, performance deteriorates. The sophisticated investor underperforms the simple beginner. Why? Because expertise creates several illusions. Illusion 1. Control. The expert believes their knowledge gives them control over outcomes. They think, I understand markets, therefore I can predict them. But markets are inherently unpredictable. No amount of knowledge changes this. The expert's illusion of control leads to overconfidence and excessive risk-taking. The beginner knows they don't control markets. This humility protects them. Illusion 2. Pattern recognition. The expert's mind sees patterns everywhere. Ah, this looks like 2008. This reminds me of the tech bubble. This is clearly a bear market rally. But markets don't repeat. They rhyme at best. The patterns the expert sees are often phantom patterns, projections of their expectations onto random noise. The beginner doesn't see patterns because they don't expect them. They see reality as it is, not filtered through pattern templates. Illusion 3. Superiority. The expert believes their sophisticated strategies are superior to simple ones. But decades of research proves the opposite. Index funds outperform 85 to 90% of actively managed funds over 15+ years. Simple asset allocation beats complex strategies. Buy and hold beats trading. Simplicity beats sophistication. The expert's mind rejects this evidence because it threatens their identity as an expert. The beginner's mind accepts evidence without ego attachment. Cultivating Shoshin in your investing. So how do you maintain beginner's mind, especially after you've gained experience? Here are the practices. Practice 1. Embrace I don't know. Make a habit of saying and meaning, I don't know what markets will do next. This isn't defeatism, it's honesty. Nobody knows what markets will do next. Not economists, not analysts, not billionaire investors. Every investment decision should start from I don't know the future rather than I've figured it out. This humility prevents catastrophic mistakes born of false certainty. Practice 2. Stay with simple strategies. Fight the urge toward complexity. Every time you feel tempted by a sophisticated strategy, ask, will this actually improve results or will it just make me feel smarter? Usually it's the latter. The beginner's strategy, broad diversification through index funds, consistent contributions, long-time horizon, remains optimal even after decades. Don't graduate from what works to what's impressive. Practice 3. Treat every market environment as new. Even if you've lived through multiple cycles, approach each new situation with fresh eyes. Don't assume this is just like 2008 or this is obviously a bubble. Ask instead, what is actually happening right now? What do I actually know versus assume? What's the most straightforward response? This prevents fighting the last war. Each cycle is unique. Beginner's mind sees the uniqueness. Practice 4. Learn without accumulating. This is subtle but crucial. You can learn continuously without accumulating dogmas and certainties. The expert accumulates beliefs. Stocks always outperform bonds long-term. Gold is a hedge against inflation. You must own international stocks. The beginner learns principles but holds them lightly. Nothing is absolute. Everything is contextual. Read widely, study history, understand principles. But don't let knowledge harden into rigid beliefs. Practice 5. Value simplicity over intelligence. The expert wants to appear intelligent. This leads to unnecessary complexity. The beginner values what works over what impresses. They're comfortable looking simple, even naive, if simplicity produces results. Warren Buffett, one of the world's wealthiest investors, uses strategies a child could understand. That's beginner's mind at the highest level. The beginner's mind portfolio. What does a beginner's mind portfolio look like? It's almost boring in its simplicity. The three-fund portfolio total stock market index, 60%, total international index, 20%, total bond index, 20%. That's it. 3 funds, set it and forget it. No stock picking, no market timing, no cryptocurrency, no options, no REITs, no gold, no sector funds. Just broad, diversified, low-cost exposure to global stocks and bonds. The expert looks at this and thinks, too simple. Surely I can do better. The beginner looks at this and thinks, this covers everything. Why complicate it? Over 30 years, the beginner's 3-fund portfolio will outperform 90% of expert portfolios. Not because it's brilliant, because it's simple, low-cost, and consistent. The paradox of knowledge. Here's the paradox. The more you learn about investing, the simpler your strategy should become. Beginners often think knowledge leads to complexity. The path looks like beginner, simple, intermediate, complex, expert, very complex. But the actual path of wisdom is beginner, simple, naive, intermediate, complex, trying to be clever, wise, simple again, but informed. The wise investor returns to simplicity. But it's a different simplicity. The beginner is simple because they don't know alternatives. The wise investor is simple because they have explored alternatives and returned to simplicity with understanding. Case study: the MIT Nobel laureates. Let me tell you about long-term capital management. In 1994, a hedge fund was founded by bond trader John Meriwether, joined by Myron Scholes and Robert Merton, Nobel Prize winners in economics, and other luminaries. They had the expert's mind in extreme form, brilliant, sophisticated, certain. They created incredibly complex mathematical models for trading. For a few years, they generated spectacular returns. They felt validated. Their expertise was being rewarded. Then in 1998, their models failed. The fund collapsed, losing $4.6 billion. They nearly brought down the global financial system. What went wrong? Not lack of intelligence or knowledge. They had more of both than almost anyone. What they lacked was beginner's mind. They were so certain, so sophisticated, so convinced their models captured reality that they took massive risks. Meanwhile, simple index fund investors, who knew far less, who maintained beginner's mind humility, sailed through 1998 relatively unscathed. The experts nearly destroyed the system. The beginners were fine. Beginner's mind in market crashes. Let me show you how beginner's mind responds to crashes differently than expert's mind. March 2020, COVID crash. Expert's mind response. This is unprecedented. We've never seen a pandemic-induced crash. The models don't know how to price this. We need to completely rethink our strategy. Sell everything until clarity emerges. Result: sells at bottom, misses recovery. Beginner's mind response. I don't know what happens next. Markets have crashed before and recovered before. My strategy is designed to survive uncertainty. I'll continue my plan. Regular contributions, stay invested. Result: buys during crash, captures full recovery. The expert's mind needs to understand before acting. The beginner's mind acts on principles without needing complete understanding. Ironically, the beginner's approach produces better results because markets reward humility and punish arrogance. The questions of beginner's mind. Instead of making statements of certainty, cultivate questions. Expert statement: the market is clearly overvalued. Beginner question: what does valuation actually predict? When has it been a reliable timing tool? Expert statement: inflation will destroy bond returns. Beginner question: what do bonds actually do in my portfolio? Is return maximization their only purpose? Expert statement: everyone should own Bitcoin. Beginner question: do I understand this asset well enough to own it? What purpose would it serve? Notice how questions keep the mind open while statements close it. The meditation of not knowing. Here's a practice that cultivates beginner's mind. Sit quietly for 10 minutes. Think about your portfolio. Notice all the things you think you know. Stocks will go up long term. My retirement timeline is accurate. I understand my risk tolerance. Index funds are optimal. Now, for each knowledge, ask, how do I actually know this? What if I'm wrong? What would it feel like to not know? This isn't about creating doubt in everything. It's about softening the hardness of certainty, creating mental flexibility. The beginner's mind is flexible. It can adapt because it's not rigid with knowledge. Returning to beginner's mind. If you've become an expert investor, lots of knowledge, complex strategies, strong opinions. How do you return to beginner's mind? Step 1. Audit your complexity. List all your holdings, strategies, and rules. For each, ask, does this add real value or just complexity? If you can't clearly articulate the value, simplify. Step 2. Practice epistemic humility. This means being honest about the limits of your knowledge. Make a list. Things I actually know. Things I think I know. Things I definitely don't know. You'll find the first list is much shorter than you assumed. Step 3. Return to first principles. What's the simplest strategy that would work? Start there. Only add complexity if you can prove, not assume. It adds value. Step 4. Learn from actual beginners. Teach investing to someone who knows nothing. Notice their questions. They're often more penetrating than expert analysis because they're unfiltered by assumptions. The questions a child asks about investing often reveal profound truths experts have forgotten. The Shoshin Portfolio Review. Once per year, review your portfolio with beginner's mind. Imagine you're starting from scratch today with your current knowledge but without attachment to current holdings. Ask, if I were beginning today, would I build this exact portfolio? If no, what would you change? Maybe you should change it. If yes, great. Your portfolio survives beginner's mind scrutiny. The liberation of not knowing. Here's what beginner's mind gives you. Freedom from anxiety. You're not burdened by needing to predict or control. Protection from overconfidence. You can't make catastrophic mistakes if you don't think you know everything. Openness to reality. You see what's actually happening rather than what you expect to happen. Simplicity. Your strategy remains effective and easy to maintain. Peace. Not knowing is restful. Certainty is exhausting. The Zen master Shunryu Suzuki said, "The mind of the beginner is empty, free of the habits of the expert, ready to accept, to doubt, and open to all possibilities." This is the mind that builds wealth. Empty of certainty, full of possibility, humble enough to stay with what works. Your Shoshin practice. Starting today, say, I don't know 10 times daily. About markets, economics, predictions. Mean it. Simplify one thing in your portfolio. Remove one unnecessary complexity. Question one certainty. Pick something you're sure about. Ask, what if I'm wrong? Learn like a beginner. Read one investing book as if you know nothing. What surprises you? This is Shoshin, beginner's mind. This is the third secret to building your million-dollar fortune. Approaching markets with humility and openness rather than certainty and complexity. Synthesizing Eastern wisdom with Western strategy. Now let me show you how these three principles, Wu Wei, Yin Yang, and Shoshin, come together into a concrete, actionable investment strategy that can build you a million-dollar fortune. This isn't purely Eastern mysticism. It's Eastern wisdom integrated with Western financial knowledge to create something more powerful than either alone. The three-phase wealth building path. Phase 1. Foundation, ages 25 to 40, or years 1 to 15. This is the accumulation phase. You're building your first $100,000, then $250,000, then $500,000. Wu Wei applications set up automatic monthly investments. Choose simple, diversified index funds. Check portfolio no more than quarterly. Ignore financial news. Let compounding work undisturbed. Yin Yang application. Continue investing through all market phases. Actually increase contributions during bear markets if possible. Resist urge to get more aggressive during bull markets. View downturns as sale prices, not disasters. Shoshin applications. Stick with simple strategies. Don't complicate as you learn more. Resist stock picking and market timing. Maintain humility about your knowledge. Concrete actions. Open a low-cost brokerage account. Vanguard, Fidelity, Schwab. Set up automatic monthly contribution, $500, $1,000, whatever you can afford. Invest in one of two options. Option A, single target date fund, matching your retirement year. Option B, three-fund portfolio, 60% U.S. stocks, 20% international stocks, 20% bonds. Set calendar reminder for quarterly check-in only. Otherwise, forget the portfolio exists. Expected timeline in Phase 1. Year 5, approximately $40,000, if saving $500 per month at 8%. Year 10, approximately $95,000. Year 15, approximately $175,000. You're still far from $1 million, but the foundation is solid and the compounding machine is humming. Phase 2. Acceleration, ages 40 to 55, or years 15 to 30. This is where compounding becomes visible. Your portfolio's returns start exceeding your contributions. Wu-Wei application. Continue the same strategy. Resist urge to optimize or get fancy. The less you do, the faster wealth builds. Protect the compounding process. Yin-Yang application. By now you've lived through 1 to 2 market cycles. Use this experience to strengthen cycle awareness. Rebalance slightly toward bonds as you age. 70% stocks, 30% bonds by 50. Maintain counter-cyclical psychology. Shoshin application. By now you know a lot about investing. Danger, expertise creep. Deliberately maintain simplicity. Don't let knowledge corrupt effective strategy. Concrete actions. Continue automatic contributions, increasing with raises. Once per year only, rebalance. If portfolio has drifted greater than 10% from targets, gradually shift allocation. 60-20-20 at 45, 50-20-30 at 55. Stocks, international bonds. Do nothing else. Expected timeline in Phase 2, Year 20, approximately $375,000, if saving $750 per month at 8%. Year 25, approximately $675,000. Year 30, approximately $1,100,000. Notice you've crossed the $1 million threshold. Not through genius or luck or complexity. Through simple, consistent application of Wu-Wei, Yin-Yang, and Shoshin. Phase 3. Preservation. Ages 55 to 70, or years 30 plus. You've reached the $1 million. Now the goal shifts from accumulation to preservation and distribution. Wu-Wei application, no dramatic changes. Gradually become more conservative. Continue letting compounding work. Minimize interference. Yin-Yang application. Shift allocation toward preservation, 50-20-30 by 60, 40-10-50 by 70. Still maintain some equity exposure for growth. Balance security with inflation protection. Shoshin application. Resist urge to get conservative too fast. Don't let fear of loss override need for growth. Stay humble about timing retirement/markets. Concrete actions. Shift to 4% withdrawal rate at retirement. Maintain 40 to 50% stock exposure even in retirement. Use bond/cash holdings for spending. Let stocks compound. Rebalance annually. The complete 30-year plan. Let me show you the complete numbers. Starting age, 35 monthly contribution, $800 increased with raises to $1,200 by year 15. Average annual return, 8% final age, 65. Year-by-year milestones, year 5, age 40, $62,000. Year 10, age 45, $151,000. Year 15, age 50, $290,000. Year 20, age 55, $501,000. Year 25, age 60, $830,000. Year 30, age 65, $1,310,000. You've built a $1 million fortune. The 3 principles made it almost effortless. Wu-Wei, you weren't exhausting yourself with constant activity. Yin-Yang, you dance with cycles instead of fighting them. Shoshin, you maintain simple, effective strategy throughout. The asset allocation evolution. Here's how your allocation evolves with age. Ages 25 to 40. Accumulation, 80% stocks, 60% US, 20% international, 20% bonds, aggressive but diversified. Ages 40 to 50. Building, 70% stocks, 50% US, 20% international, 30% bonds. Still growth-focused but moderating. Ages 50 to 60, pre-retirement, 60% stocks, 45% US, 15% international, 40% bonds, balancing growth with preservation. Ages 60 to 70, early retirement, 50% stocks, 40% US, 10% international, 50% bonds, preservation with growth. Ages 70 plus, late retirement, 40% stocks, 35% US, 5% international, 60% bonds. Safety first, but some growth for longevity. This gradual shift embodies yin-yang, adjusting to different life phases while maintaining balance. The common mistakes this approach avoids. Let me show you what this Eastern-Western synthesis protects you from. Mistake 1. Overtrading. Wu Wei prevents this through non-action principle. Result: save thousands in fees, taxes, and poor timing. Mistake 2. Panic selling. Yin-Yang principle helps you expect and accept downturns. Result: stay invested through crashes, capture recoveries. Mistake 3. Overconfidence. Shoshin prevents false certainty. Result: avoid catastrophic mistakes from thinking you know more than you do. Mistake 4. Complexity creep. All three principles favor simplicity. Result: strategy remains effective and easy to maintain. Mistake 5. Analysis paralysis. Wu Wei says, simple decision then non-doing. Result: start investing instead of perpetually researching. The practical weekly routine. What does this philosophy look like in daily practice? Here's your weekly routine, Monday through Saturday. Do absolutely nothing investment-related. Live your life. Don't check portfolio. Don't read financial news. Don't worry about markets. Sunday, once per quarter only. 10-minute portfolio check. Confirm automatic contribution still happening. If needed, rebalance. Takes 15 minutes maybe. Otherwise, do nothing. Annual review, 1 hour per year. Check if allocation has drifted, usually hasn't. Confirm strategy still appropriate for age/goals. Make micro adjustments if needed. Otherwise, continue as is. That's it. You're spending less than 5 hours per year on investing. The other 8,755 hours are yours to live. The crisis management protocol. But what about crashes? What do I do when markets collapse? Here's your crisis protocol based on the 3 principles. When markets drop 10-20%, minor correction. Do absolutely nothing. Don't even check more frequently. This is normal market behavior. When markets drop 20 to 40%, major correction, cheer bear market. Check once to confirm automatic contribution still occurring. Consider increasing contributions slightly if you have capacity. Otherwise, do nothing. Remember yin-yang. This is winter, spring is coming. When markets drop 40% plus, crash crisis. This is extraordinarily rare, 2008, 1929, 2020. Check to confirm you're still employed and have emergency fund. If yes, continue strategy unchanged, possibly increase contributions. If no, pause contributions temporarily. Use emergency fund, resume when able. Remember, these create generational buying opportunities. The key: the worse markets get, the less you should do, unless forced by job loss, emergency. Your instincts will scream to act. Wu Wei says don't. The optimization fallacy. Let me address the expert mind's objection. But couldn't I get better returns with a more sophisticated strategy? Maybe, but probably not. And here's why it doesn't matter. The difference between simple strategy returning 8% for 30 years, optimized strategy returning 9% for 30 years, on $800 per month contributions is 8% with $310,000, 9% $1,570,000. Difference $260,000. Is that extra $260,000 over 30 years worth? Hundreds of hours of additional research? Increased complexity and stress? Higher risk of catastrophic mistakes? Reduced quality of life from constant monitoring? I would argue no. The simple strategy gets you to the destination with minimal pain. That's victory. The expert mind wants to maximize. The wise mind wants sufficiency achieved peacefully. The geographic arbitrage consideration. One Western strategy that harmonizes beautifully with Eastern philosophy: geographic arbitrage. If you build $1 million through this approach and retire at 55, you have options. Option A: stay in high-cost country. 4% withdrawal equals $40,000 per year, plus Social Security at 62 to 67 equals $50,000 to $60,000 per year total. Comfortable but modest lifestyle. Option B: move to low-cost country. Same $40,000 to $50,000 per year in Portugal, Mexico, Thailand, Ecuador. Live like upper middle class. Exceptional quality of life. This isn't necessary, but it's an option the philosophy supports. Wu Wei suggests flowing toward ease rather than staying where life is harder. The inheritance and legacy question. Eastern philosophy emphasizes impermanence. Nothing lasts forever, including your wealth and your life. This creates healthy perspective on legacy. If you die at 85 with $800,000 remaining, having spent from your $1.3 million over 30 years of retirement, your heirs inherit that amount. Is that sufficient? The beginner's mind asks, what is enough to leave? Rather than maximizing inheritance, you've balanced your own comfortable retirement, helping children during your lifetime, when it matters most, leaving meaningful but not excessive inheritance. The yin-yang approach. Balance between generations, neither hoarding nor depleting. Your implementation checklist. Let's make this completely concrete. Here's your implementation checklist. Week 1, open low-cost brokerage account. Set up automatic monthly transfer from checking. Choose investment vehicle, target date fund, or 3-fund portfolio. Make first investment. Week 2, set calendar reminders. Quarterly review only. Unsubscribe from financial news emails. Delete stock tracking apps. Commit to Wu Wei. No checking for 90 days. Year 1. Contribute consistently. Don't check frequently. Survive first market downturn without panic. Complete 4 quarterly reviews, took 10 minutes each. Celebrate. Foundation established. Years 2 to 30. Continue automatic contributions. Gradually increase contributions with raises. Rebalance once per year if needed. Adjust allocation gradually toward bonds as you age. Otherwise, Wu Wei, Yin Yang, Shoshin. Year 30. Celebrate. $1 million fortune achieved. Shift to 4% withdrawal strategy. Continue letting 40 to 50% grow in stocks. Enjoy freedom earned through patient discipline. This is the complete strategy. Eastern philosophy integrated with Western financial tools. Simple, effective, peaceful. The way of intelligent wealth. We've covered a lot of ground. Let me bring this all together and show you what this Eastern-Western synthesis really means for your life. The 3 principles summarized. Wu Wei, effortless action. The less you do with your investments, the better they perform. Set up a simple system and let it run. The compounding needs time and non-interference, not constant activity. Yin-yang, complementary opposites. Markets move in cycles. Bull and bear, euphoria and despair. These aren't enemies to defeat, but natural rhythms to dance with. Stay balanced, think counter-cyclically, and use extremes as opportunities. Shoshin, beginner's mind. Maintain humility and simplicity despite growing knowledge. The simple strategy that works is better than the sophisticated strategy that impresses. Don't let expertise corrupt effectiveness. The real wealth. But here's what I really want you to understand. This isn't just about building $1 million. The $1 million is almost incidental. What you're really building through this practice is peace of mind. No anxiety about markets, no obsessive monitoring, no sleepless nights worrying about your portfolio. Financial peace is worth more than any additional return. Time freedom. Spending 5 hours per year on investing instead of 5 hours per week gives you back 255 hours annually. Over 30 years, that's 7,650 hours, nearly a full year of life reclaimed. Psychological health. Not being buffeted by market emotions. Not comparing yourself to others. Not feeling inadequate when markets soar or terrified when they crash. Equanimity is priceless. Life balance. Energy and attention available for relationships, health, creativity, growth, service, not consumed by financial optimization and wealth maximization. Wisdom. Understanding the limits of knowledge and control, recognizing patterns of reality. developing patience and perspective. These intangible benefits are actually more valuable than the $1 million they produce. The paradox revisited. Remember what I said at the beginning. The more tightly you grasp at wealth, the more it slips away. The more lightly you hold it, the more it accumulates. This isn't mystical. It's psychological and behavioral. Tight grasping produces overtrading, destroys returns. Panic decisions locks in losses. Excessive risk-taking leads to wipeouts. Analysis paralysis prevents starting. Stress and anxiety clouds judgment. Light holding produces patience, allows compounding. Emotional stability prevents panic. Appropriate risk balances growth and safety. Decisive simplicity enables action. Peace and clarity improves decisions. The paradox resolves. Letting go of desperate grasping actually produces better results. The comparison trap. One of the hardest aspects of this path is that it won't make you feel clever. You won't have impressive stories about trades you made or stocks you picked. Your colleague will tell you about how he made 50% on some stock last year. You'll have nothing to say except, I put money in my index funds like I do every month. He'll seem sophisticated. You'll seem simple. But in 30 years, you'll have $1 million and peace of mind. He'll probably have less of both. The way of intelligent wealth doesn't look impressive to others. It looks boring. And that's perfect. As soon as you need your investing to make you look clever, you've lost the way. You're investing for ego, not outcomes. The cultural resistance. Everything in Western culture will resist this approach. Financial media needs you watching constantly. Their business model requires your attention. Financial services industry needs you trading frequently. Their profits come from your activity. Consumer culture needs you feeling inadequate, so you'll buy things to feel better. Status culture needs you comparing, so you'll chase more to win. This path rejects all of that. It says, I don't need to watch financial TV. I don't need complex financial products. I don't need luxury goods to feel successful. I don't need to compete with anyone. This is countercultural. It requires independence. But that independence is part of the wealth. The spiritual dimension. I want to touch on something that might make some uncomfortable. The spiritual dimension of this approach. I'm not asking you to become a Buddhist or Taoist, but I am suggesting that the relationship you have with money is fundamentally a spiritual question. Do you trust that sufficiency is real? Or do you believe only in scarcity and never enough? Can you find contentment in the present? Or must you always live for some future achievement? Can you accept not knowing the future? Or must you have control and certainty? These are spiritual questions disguised as financial questions. The Eastern traditions say reality is characterized by impermanence, uncertainty, and interdependence. Fighting these truths creates suffering. Accepting them creates peace. Your $1 million fortune will be built on either fighting reality, anxiety, force, grasping, or accepting reality, peace, flow, patience. One path produces wealth and suffering. The other produces wealth and peace. The death reflection. Let me get dark for a moment. Eastern philosophies often use death as a teacher. Imagine you're on your deathbed at 85. You're reviewing your life. Which scenario brings more satisfaction? Scenario 1. I built $3 million through aggressive investing. I monitored markets constantly. I optimized everything. I was stressed for 40 years, but I maximized wealth. I spent my final decade spending down a fortune I was too tired to enjoy. Scenario 2. I built $1.3 million through patient, simple investing. I rarely thought about markets. I optimized life quality over portfolio size. I was peaceful for 40 years and had sufficient wealth. I spent my final decades with energy to enjoy what I'd built. Which life was wealthier? Death clarifies. From that perspective, can you see that $1.3 million built peacefully beats $3 million built anxiously? The legacy you leave. Beyond money, what are you modeling for others? If you have children, what are you teaching them about wealth? The conventional approach teaches. Wealth is about maximization. Money requires constant worry. Satisfaction is always in the future. Complexity is better than simplicity. You're never wealthy enough. The way of intelligent wealth teaches. Wealth is about sufficiency. Money can be handled peacefully. Satisfaction is available now. Simplicity usually beats complexity. Enough is enough. Which lessons serve your children better? The practice of gratitude. Let me give you one final practice that ties everything together. Once per month, take 10 minutes for financial gratitude. Write down 3 things you're grateful for financially. Not aspirational things you want, but things you already have. Examples: I saved $800 this month. My investments grew $2,000. I have no credit card debt. I can afford quality food. I have emergency savings. I'm on track to reach my goals. This practice transforms your relationship with money from scarcity, what I lack, to abundance, what I have. Over time, you'll feel wealthier at every stage of the journey, not just at the destination. The beginning, not the end. Everything I've shared, Wu Wei, Yin Yang, Shoshin, these aren't just investment strategies. They're life principles. Once you begin practicing them with money, you'll notice they apply everywhere. Wu Wei in relationships. Stop forcing, start allowing yin-yang in career, understand cycles, balance work and rest. Shoshin in learning. Stay humble, remain open. The wisdom that builds financial wealth builds human wealth too. That's the ultimate secret. This isn't really about money. It's about living wisely. The $1,000,000 is just what happens when you do. The permission and the warning. Let me give you both permission and warning. Permission: you don't need to make investing complicated. You don't need to be a financial expert. You don't need to spend hours on this. You don't need to maximize every dollar. You can build wealth peacefully. Warning: this path looks too simple to work, but it does. You'll be tempted to complicate it, resist. You'll doubt yourself during downturns. Don't. Others will mock its simplicity. Ignore them. You'll feel you should do more, you shouldn't. The hardest part of this path is trusting it's enough. But it is. The invitation. I'm inviting you to a different relationship with wealth building. One that doesn't dominate your life. One that doesn't create anxiety. One that flows with reality rather than fighting it. You can start today. Today, open a brokerage account, set up automatic investment. Tomorrow, choose simple index funds, target date or 3-fund. Next week, make first investment, set calendar reminder for quarterly review. Next 90 days, check nothing, worry about nothing, live your life next 30 years. Continue automatic contributions. Check quarterly, otherwise practice Wu Wei. That's the path. Simple, peaceful, effective, the final word. The Tao Te Ching says, nature does not hurry, yet everything is accomplished. Your wealth will build the same way. Not through frantic activity, but through patient, intelligent inaction. Not through grasping, but through allowing. Not through complexity, but through simplicity. The $1,000,000 is waiting for you. Not at the end of some heroic journey of sacrifice and struggle, but at the end of a peaceful journey of consistency and patience. Wu Wei, Yin Yang, Shoshin. These 3 principles, applied with Western financial tools, create a system so powerful and so simple that it almost feels like magic. But it's not magic, it's wisdom. Ancient wisdom applied to modern reality. Eastern philosophy integrated with Western finance. The art of building wealth without destroying your peace. The choice. You have a choice right now. Path 1. Continue the conventional approach. Constant activity, anxiety, complexity. Maybe you'll build wealth, but you'll sacrifice peace. Path 2. Embrace the way of intelligent wealth. Minimal activity, peace, simplicity. You'll build wealth while preserving your life. Both paths can lead to financial success. Only one leads to holistic wealth. I can't make the choice for you. But I can tell you, I've walked both paths. The second is better. Not just for your portfolio, for your life. Your first step. Close your eyes for a moment, take a deep breath. Feel the anxiety you've been carrying about money, about investing, about not doing enough. Now exhale. Release it. You don't need to carry that anymore. There's another way. When you open your eyes, take the first step. Go online. Open a brokerage account. Set up an automatic monthly investment. Choose a simple fund. Then close the browser and go live your life. The $1,000,000 fortune will build itself while you're busy being present for what actually matters. That's the secret. That's the way. Wu Wei, Yin Yang, Shoshin, the smart investor's secret to building a $1,000,000 fortune. not through doing more, but through being wise.